All right. Good afternoon, everybody. Hope you're all doing well. Welcome to Weekly Options for Income. We're doing kind of a class overview today. All right. So what am I going to talk about today? So first of all, we have a new class coming up. I've not done a class on weeklies in maybe a year and a half or so. So I think a good time to focus on them, especially with the volatility that's been in the market. So this new class, Weekly Options for Income, so I'm going to talk about that for about 2 minutes, and then I will go over one trade for today. This is for educational purposes today. No recommendations of trades. All right, so this is going to be a 3-week class that we're doing this time, and again, it's going to start Wednesday, March 9th. Well, my nephew's starting me quicker than I thought we were. I thought we were starting the 16th, but maybe that is too far. Classes will be every Wednesday and Friday at 1 p.m. Central. All classes will be recorded and archived, and I think one of the great things about our classes is they stay archived. As long as we're around, they stay archived. Classes we did 2-3 years ago are still archived. And you can ask questions. I still get questions from people that maybe took a class a year ago, and as they're reviewing the material, they'll send me a question. And so what's nice is on our class page, there's a place you can ask questions, and it'll come to me, and all these emails come directly to me. So I answer these questions for you, which is nice. So even if you can't watch a lot of these live and you watch it taped or archived, what's nice is anytime you're looking at it, I mean, it could be 4 months after we do the class. If you buy it and get it, you can ask questions and they come right to me. So that's a really neat feature. Class is only $297 for the 6-session course, and every class will be at least an hour. A lot of times I'll go an hour and a half, but somewhere around an hour is it? And the agenda will be, again, these will be all weekly trades, and I'm going to define weekly trades for our sake. I'm dealing with trades 4 to 14 days from expiration. Right? I mean, technically, you could trade a weeklies 38 days out. Agree? You can trade weeklies, have weeklies that are 38 days out, 25 days out, 40 days out. But I'm going to trade, these are going to be options that are less than 14 days to expiration. Shorter term trades. Everybody got it? So shorter term trades, and we'll be doing some 4-day trades, trades that expire in 4 days, trades that expire in 8 days. Today I'm going to look at a trade that expires in 14 days, mainly because the class doesn't start for at least another week. So I wanted to maybe give a trade that would still be on or something more relevant when the class starts. All right, I think that's it. And so week 1, I'm going to talk about iron condors. So we have 6 classes. I'm going to devote 2 classes to iron condors, 2 to calendars, and 2 to butterflies, all very good income trades. I'm going to show you how we trade them, how I look at these things, how to manage them, how to adjust them. And what's nice is for each week, so week 1, well, today's just a kind of the launch of this. So this isn't week 1 until the class starts, even though I'm going to put a live trade on today. But week 1, 2 classes on iron condors. Each class, the iron condor I'm talking about, I'm going to put on a live trade, and we're going to follow it from beginning to end. You with me? Week 2, I'm going to put on calendar. I'm going to do calendars. Each calendar I'm talking about, I'm putting on a live trade, so we can follow. Because again, the key here is the practicality of this class, that you can see exactly how to do it, and that's what a lot of you lack, the experience. And so here we're going to go through I'm going to go through the trade, put a live trade on, follow it from beginning to end, and hopefully that'll give you a little more confidence as you're doing some of these on your own. And then week 3, butterfly. So I'm going to do a live trade today, and we'll talk about it. But week 1, I'll do 2 live trades. Week 2, 2 live trades. Week 3, 2 live trades. And we'll follow them from beginning to end. Mark says, will you have anything on SPX biweeklies? We'll look at that. If you guys want to look at the biweeklies, we can look at that. But again, I'll be looking for trades that expire, from 4 to 14 days. As I said, the class is $297. So again, it will either be starting probably next week or the week after. And let me see if there's any other issues, things I want to cover on this. There's just some information, what we do mentoring, and some, if you have any questions for us. But that's it. If you have any quick questions on this, we'll jump into today. I'm just going to look at a butterfly example so we can talk about this. But each class will have a Word doc or a PowerPoint, and I'll give you the methodology of what I'm looking at. We'll go through an example, talk about execution, talk about the plan for each trade, talk about how to manage it, what to do if it goes against you, and which vehicles I'm going to trade, which one. Some of these trades will be no touch. No touch just means no adjustments. They will have risk management, like what's our profit target and maximum loss, but for some people like no touch trades that they don't have to diddle with, right? And generally I don't do a lot of adjustments for a 3 or 4 day trade. Why? There's just not enough stinking time, right? But some of these, as I'm doing maybe 11 days out or 12 or 13, there's enough time to, if it did go against us the first day or two, we might be able to make an adjustment. So I think this will be a very helpful class for you. I think weeklies are very attractive, and even in a volatile market, a couple of the reasons weeklies are very attractive is, number one, you don't have to put as much capital out towards weekly trades as you do, weekly meaning, let's say 4 to 14 day trades, as you do 30 to 50 day trades. The other thing is, number two, a lot of times with weekly trades, we're only in it to trade 2 days. Whereas if you're in a 30, 40, 50 day trade, you're probably in it most days during the month. So if there's a big move in the market, you're susceptible. Here, a weekly trade, we might put a trade out on Monday, we might be out by Wednesday. So so from an attractiveness, people like weeklies because you put less capital in, number one. Number two, you're in the trade less. Number three, what's another reason? Yield, right? If you're making 5% a week, if you're trying to average 4 to 5% a week on a weekly trade versus let's say a 7-day trade, you're looking for 4 to 5% versus a 30 to 50 day trade, you're making 4 to 5% per trade over a year. Would you rather make 3 to 5% a week or 3 to 5% a month? And so, but on the other hand, we'll talk about the pluses and minuses. The biggest challenge with weeklies is if you have a fast-moving market. And so that's what we're going to approach this is really focus a lot on risk management and how to do this without getting your face ripped off, right? Isn't that good? Yeah, but again, there's no naked options we're doing here. We're not, and the nice thing about whatever we teach here at Sheridan Mentoring, it's not based on the price charts, because if we base everything on the price charts, you know what, 10 people are going to look at 10 different things. So these are repeatable trades that you could put on every week, and that's what we'll do. Now, good question. Greg said, if a trade needs adjustment when there is no class, will you send out an email to inform your students? Absolutely. So the class, what I'm thinking I'm going to do is the days of the class will go Wednesday and Friday at 1 p.m. Central. So we'll have Wednesday, Friday, and then Monday. If I put a trade on Monday or we have an adjustment, I will do it. I will send that out. But again, even though I want to make this as practical a class as you've ever been in, everything is live, and then I'm explaining everything we're doing. There's no, trading by the seat of the pants. I'm telling you when I'm going to adjust, how I'm going to adjust, and doing it. And I'm doing the live trades. I'm saying this is for educational for you guys because, let's face it, I don't know everybody here, do I? So if I told all you guys to go to do live trades, Do you think that would be smart on my part? Not knowing you, not knowing if some of you, right, should not be trading, right? So if I told you guys all to go trade and we'll do this live, that would not be smart on my part because I don't know any of you guys, right? Some of you I may see your trading knowledge. I say you should be in jail, right? So I can't recommend that you do live trades, but everything will be transparent on my end. Thank you, Amit. I appreciate it. I didn't pay Amit to put that in there, and but thank you, Amit. Yeah, we try to make these practical and helpful so that give you some confidence that you can go out there and for $297, hopefully save you a lot of money on this. All right, any other questions? Let's jump into, I'm just going to cover one trade today and jump in butterfly. All right, we'll talk a little bit about the market and we'll go from there. Any other quick questions? Again, we'll probably start next Wednesday or the Wednesday after. We'll let you know. You can sign up on the front page of Sheridan Mentoring. It'll be $297. And again, the beautiful thing is even if you can't watch the classes live, whenever you watch them, you throw questions in, they come to me, and I can help you with that. All right. Now, and again, it's understanding it. The reason I'm doing live trades for these 3 weeks is because some of you have perceptions that you can't trade weeklies or what the problems were or whatever, and here we're just going through it and talking about it, right? So you can see on 6 or 7 live trades, including today, how we're handling it, how we're looking at it, but again, philosophy, how we're approaching it. The main approach, segueing into the trade for today, the main way I approach weeklies, I think, is different than most folk out there. And one of it is, for the most part, we're in this every week. Whether I'm doing a 4-day trade or a 7-day trade or a 14-day trade, the idea is I'm putting it on every week. Taking a trade off every week, but putting it on every week. So, 52 weeks of the year, we're playing 52 weeks, and we're treating it like a business. These repeatable trades are putting on every week, have a good, sound risk management system, and the idea is to win a lot more than we lose, so at the end of the year, we're up pretty good. Does that make sense? And limit our losses. So it's not, a lot of you may trade weeklies or 30-day trades by, when the stars line up, when the market looks quiet, when this says this, but who the heck knows? I don't know, right? And you don't know either, right? And so we play every week, and we'll talk about during the class. I mean, obviously, I'm aware of the price levels in SPX and RUD, which are 2 of the main products that we trade. But we're going to show you how we do it. I think it'll be a good, extremely practical course for you, and hopefully will give you some good confidence to trade. Now, what products do we trade? I like Russell and SPX are probably the 2 main products that we trade in our community for index type options. Nothing wrong with SPY and IWM. Those are fine also. In terms of stocks, I like extremely liquid stocks. What's the most liquid stock? What stock trades more stock options by far than anything else out there? Do you know what that is? It begins with an A, Apple. So again, I'm not saying Apple's the best, but one of the things I look for, see, a lot of is liquidity. See, a lot of folk, they get caught up in commissions and different things, but, I don't think people are even aware how much money you give away in execution costs. If you pay up an extra nickel or you give away 5 cents or 6 cents when you're getting out of a trade, multiply that times your contracts over a year, and that's some serious money. And so Apple is a product that you can get pretty close to mid prices, 400 or 500 contracts, whatever you want. It's a great product. I think there's other very liquid products out there. If you Google and go to CBOE archived option volume, if you just Google that, go to CBOE archived option volume, it'll give you for the last month in order with the statistics, it'll rank like, 2,000 stocks and what had the most option volume. I think that'll be helpful for you. And you get that with the indexes. So the key is to stay in liquid vehicles. We have some students that'll trade in terms of weeklies. Again, I said the most popular products that we're trading for weeklies are SPX, RUT, and then when you get into stocks, some good liquid stocks, Apple, Amazon, Tesla, different stocks like that, and there's pluses and minuses to many of them. If I'm trading stocks, personally, I'd want to trade some that are, I don't want to trade all rock and rollers where rock and rollers is defined as maybe implied volatilities over 30 or 35 most of the time. So I want to trade some that are maybe a little more sedate than others. Thank you, Amit, for that option volume link. And I think that'll be a help to you. Because I think especially with weeklies, when I want to get out of my trade with weeklies, I want to get out and trust that I could get out with pretty good execution. And if you're not in liquid vehicles, you might get taken to the cleaners a bit. So today I'm just going to look real quick. We'll just look at butterflies, okay, for a little bit. I'm not trying to favor a brokerage, but today I'm using Think or Swim. I think, and I can just say this, I mean, what do I think are good brokers? Some of the brokerages that our students use that I think are very good brokers, Think or Swim, which would be TD Ameritrade, Trade King, Options House, which was the merger between Options House and Trade Monster, Options Express, and Interactive Brokers. I think those were about the 5 main ones our community uses. Is there any other good ones out there that you guys use that I missed there? Are there any good brokerage firms for options that I missed that any of you guys use? I don't want to miss any, but those are the main ones that most of the students use. As I said, IB, what's TS, Thomas? Oh, TradeStation. Yeah, I've had some that use it. We don't have many that use TradeStation. It doesn't mean TradeStation's bad. It's just we don't have as many that have used it. But the 5 I mentioned are pretty good. Let me just say this while we're getting into execution for a second. Let me ask you, some of you might say, hey, Dan, what is a good what's the word? What is a good commission rate? And what do you think is a good commission rate? I would say in this era, right? In this era, if you're spending over, 50 cents to $1 per contract, and no ticket charge is pretty normal. So 50 cents to $1 is good. And just give you an understanding of a couple things. I'm not sure if everybody's aware of this. How many of you, do any of you have an account at Options House? Any of you have an account at Options House, which has merged with Trade Monster? Any of you have an account at Options House, which is really the new firm of Options House / Trade Monster? And what do you pay for an SPX contract? I just want to give a little bit of information. What do you pay for doing something in SPX? What's your rate? It's a lot of, anybody know? But anyway, let me leave it at that. I better get into the butterflies, but 50 cents to $1. All right. So real quick, let's look at this, and then we'll go from there. So right now, as we speak in SPX, SPX is at 1988. And I just want to give a little bit of perspective. Anybody in here remember the correction that we've recently had? Any of you? Any of you that have been in the United States? Right? Anybody remember the correction? So the correction started right here, which is around December 29th was the last update. Everybody see that? And we went 3 weeks down, 300 points. In SPX, right? We went from 2100 level. So not in October, this one in January. Went from 2100 all the way down, if you take the low here, to about 1810. All right, so that's down. That move was about 13%. And that move took 3 weeks. So it's amazing, isn't it, how quick the elevator goes down. 300 points in approximately 3 weeks. From that point, which is approximately January 1920, somewhere around there, over the last 6 weeks, right, over the last 6 weeks, up until Tuesday, because Tuesday we kind of broke through the upper end of the range, the last 6 weeks since roughly January 19th to March 1st or so, we've been, believe it or not, in a very expensive $2,000 vehicle, we've been in a range of basically 1805, 1810 to 1950, 1955. So the last 6 weeks we've been in a, we've been in a range. It seems more volatile because we're going from one end of the range to the other pretty quick. So we've been in an 1805, 1950, 1955 range, and then Tuesday, was it Tuesday? The update? Yeah, Tuesday, what day is today? Today's Thursday. Tuesday was which way was the down day? Monday was the down day. That's right, because I went to the zoo. Tuesday, we broke through here. I don't know where we're going from here, but we kind of broke through that range. So again, in summary, we had this big correction that took 3 weeks, ended about January 20th. Then the last 6 weeks, we've been in this range of 1805 to 1950, 1955. And then Tuesday, we bumped out a little bit. And that's what's going on. So in terms of range, is a 150-point range on a $2,000 vehicle for 5 weeks, 6 weeks, is that unusual? Is to have a 150-point range in a $2,000 vehicle crazy? Yes or no? I'm going to give you an answer. No. I don't think it's crazy at all. That's not outrageous. What's outrageous is the speed. If you look at the big red candles there, I think that's what's miffed everybody, right? So that's the environment we're in right now. And let's face it, the biggest up moves I'm ever concerned about are up moves following a period of a correction, right? Now, let's move into the trade for today. So what I was looking for when, and I'll be able to get into a lot more during the class, but let's look at butterflies. I think butterflies are a very popular short-term, they're a very popular strategy in our community, but they're a very popular short-term trade. What's the #1 reason you think butterflies would be a tremendous income vehicle for trading weeklies, trades 3 to 14 days from expiration? What's the #1 reason why retail traders should love butterflies? What do you think? Premium is good, but what's the best? Is it a good risk reward or bad risk reward? Is it a good risk reward? It's a stinking awesome risk reward, right? With a capital A. So let's talk about it. Right now, SPX is 1986, so I'm going to look at the money. I usually go at the money on the butterflies. So here's what I'm looking at. I am looking at this butterfly. I'm in the regular March expiration. You with me? I'm in the regular March expiration. Who can tell me the regular March expiration? How many days till expiration? Who can tell me? The regular March expiration, how many days to expiration? 14. Thank you, Bill. So I'm looking at the regular March expiration, 14 days out. The reason I'm doing a 14-day trade today is because class doesn't start for another week, so I'm going out to kind of the limit of what I would cover in this upcoming class, 14 days. I'll be doing a lot of trades 4 days out, 7 days out, 9 days out. But this is a 14-day trade. And again, I'm selling premium on all of my trades. What does that mean in English? The options I'm selling more extrinsic value than I'm buying. So in this trade today, I'm doing an iron butterfly. It's a call credit spread and a put credit spread. So I'm going to basically, with SPX at 1986.68 or so as we speak, going closest at the money. So I'll just do it on I'm buying. I'll just use one contract for here, but you can see I'm buying for the March expiration, 14 days out. I'm buying the 1985 calls. That's my protection. I'm selling 10. If you do 1, it's just divided by 10. Of the 2005 calls. Why don't I use, you know what? Why don't I use for illustrative purposes, just for the math, why don't I use buy 1, sell 1? Let's use 1. It's easier for everybody to get the numbers. On the put side, I'm selling 1 at the money, 2005 put, and I'm buying, I'm sorry, I'm making mistakes here, aren't I? Sorry about that. I'm selling the 1985 put, and I'm buying the 1965 put. All right, so I want to make sure everybody knows what I'm doing here. So SPX is around 1987, 1986, right around there. I'm going at the money, selling the, oh boy. I'm selling 1 1985 call. I'm selling 1 1985 put. I'm buying my wings 20 points away in the 1965 puts and the 2005 calls. I'm in the March expiration, 14 days out. SPX is 1987 right now, 86, 87. It's closer to 1985 when starting. I'm selling the at-the-money call, 1985 call, at-the-money put, 1985 put. Buying my wings about 20 points out for the butterfly. All right, and I just did this live in the last 10 minutes a few times. I was doing at different prices just so I wanted to see exactly what price could I get filled and what price couldn't I get filled. And I did this for a $17.40 credit. I did that live with the stock right around this level within a point. Everybody with me? Is it clear to everybody what I'm doing here? Anybody not clear what I'm doing? Is anybody not clear what I'm doing here? All right, Dan says, I thought it was supposed to be a butterfly, all calls or puts. All right, so let's, it's a good question. That is a good question. So let's answer that. So we've got a couple questions here. Why only 20 points wide? All right, so first question is, I thought this was supposed to be a butterfly. Okay, so let me ask you a question. Let's go through this together. There's 3 butterflies that have the exact same graph of this. You with me? So this is an iron butterfly at the 1985 strike, right? So this is an iron butterfly at the 1985 strike. It's a calls and puts credit spread. But what if we do an all-call butterfly? What if I bought, let's say, an all-call butterfly in March? If I used similar strikes, so I'm selling the 1985, buying the 1965, and buying the 2005. So this would be an all-call butterfly, buying the 1965s, selling the 1985s, buying the 2005s. Or, and that's just called a butterfly, or I could do it in all in puts, right? Buy 1, sell 2, buy 1, same strikes in the puts. So there's 3 ways I can do this. And what I'm basically saying is they are all the same. Let me say it in Spanish and Somalia. They are all the same. So whether I use these strikes and do all calls, all puts, or do the iron butterfly, which is calls and puts, it's the same thing. Does everybody get it? So whether I do a debit butterfly, if I do it all calls, that's going to do a debit. All puts will be a debit. An iron butterfly will be a credit. Let me say this again. I'll do it in French this time. They are all the same. If you think one is better than the other, do it, right? You're wrong, but do it. It doesn't matter, right? Whether you do an all-call butterfly, all put, or an iron butterfly, if it's the same strikes, it's the same thing. You're going to have the same graph, right? Now, why do I teach iron butterfly a lot? Well, because people who are used to doing call credit spreads or stuff, you know, when you take them from a call credit spread to an iron butterfly, which is very similar to an iron condor, they get it, right? Now, so I did this for a credit of $17.40 credit. Right now, the butterfly is trading for $17.35. So I got it, it looks like 5 or 10 cents better than the mid price. SPX now is $19.85. I executed this butterfly, and SPX was in the 1986-87 area. Had a big difference, you know, 3-4 points. And I tried getting it for $17.50. I couldn't. This seemed to be the price. Now again, I'm not encouraging anybody to do this live. I'm doing this for an example. But right now, the mid prices are $17.30. Now let me ask you a question. If I go to my brokerage firm, what is my margin or risk on this trade? What is my margin or risk on this trade? It's $260. That's it. If SPX goes to 0 or a billion, for every one time I do it, I have risk 260. If I do it 10, if I do it one time, I have $260 of risk. If I do it 10 times, my margin is $2,600. How did I get that? How do I get risk of that? If you look, remember, let's see. Remember, if I'm buying the 1985s, and I'm selling the 2005 in the calls. I'm selling the 2005 in the puts, and I'm buying the 1985s. What's the width of my spreads? What's the width of my spreads? What's the width of my spreads? Anybody know? What's the width of the spreads? 20. So I have $2,000 of risk every one contract. What minus, so if SPX goes to 0, my risk is 2,000 minus my credit of 1,740, which gets me 260. So if I'm trying to make 20% on this trade or whatever I'm trying, 20%, it's of this number, not my credit. Does everybody understand that? Does everybody understand that? You have any questions on that? So it's a great risk-reward trade, but again, anytime you do something right at the money, it's a good risk-reward. You're not getting probabilities. Any questions on that before we go further? So this graph is the graph at expiration. Right? And you can see our short strike is at 1980, short strike is 1985. Now, if I put this on today, it's a 14-day trade. I'm looking to be out of this probably by Tuesday, right? We're going to go over a few other things on this. This is your graph at expiration in 14 days. So you can see at a 10 by 20 by 10 spread, you make your most money at the short strike. This graph is the picture of your graph today, and it's fluctuating a bit. Or now it's here, I'm sorry. So this is your graph today, how the graph looks, and this is your graph at expiration. All right, let's talk a little bit about the Greeks. If you look at the Greeks of the trade, one second. And this is the 1985 butterfly. And you'll see the graph changing just because mid-prices can change pretty quick in SPX. But you look basically on a 10 by 20 by 10 spread. And any questions you have, I'll answer in a minute and we'll be done here. At a 10 by 20 by 10, we're starting out with position deltas around 38 deltas short. So if this were 1 by 2 by 1, we'd be 3.8 deltas short. But on 10 by 20 by 10, it's 38 deltas short. A little negative gamma, 0.74. The theta is $105. So for every day that not much happens, we have theta of about $105. This is a short Vega trade. So if option volatilities go down, if each of the options implied volatility went down a point, we'd make $213. So some of you may look at short deltas and say, Dan, you're leaning towards the downside, but I'm not, because you know there's two risks in a butterfly or anything else, like a credit spread or anything else, and you have two risks. Price risk, and you look at delta, and volatility risk at Vega. So usually you want those offsetting. A little bit of short delta for the Vega. And here we're short 39 delta, or 3.9 deltas in a 1 by 2 by 1. This is 10 by 20 by 10. And Vega of 200. And so the whole idea here is, and we'll teach more in classes, having a plan on each trade And as long as we're kind of in this window, as long as we're within the profitable area here, we're pretty good. And then once we start moving outside of here, that's where we talk a little bit more discussion on adjustments and what we would do. So there's three parts of a plan as you're making a plan. You have number one, well, what's your profit target? And point 1 and 2 are more important than point 3, so your profit target. I'll just mention this, I'll do whatever questions you have, and then we'll let you go. So you have a profit target, you have a max loss. Again, these are repeatable trades. You have a max loss, and you get out at the max loss, right? It's not a max suggestion, it's a max loss. And then number 3, if you are going to adjust, what do you adjust? Now, a lot of times with weekly trades, I like to just have a profit target and a max loss and just get out when you get out. You know, just a numbers game. You do 50 of these in a year. Your winners you take off, your losers you take off, and the idea is that you'd be up generally much more on your winners than your losers. Adjusting is, it doesn't change 1 and 2. It's just saying before you hit the max loss, if you want to adjust it to prolong or to help your problem area, that's what you would do. And so we're going to talk about adjustments. On this, and as far as how you would adjust these trades when they go against you. So, you know, typically for a butterfly, anywhere from 10 to 20% is the profit target on a weekly that we will seek. And I don't want to lose more than, let's say, 15 to 20%. But usually, and I'll just give you this, so that's our target per week, but reality, you know, we've been trading as a community pretty heavily from day one the weeklies came out, and I would say the people in our community who trade weekly trades every week for the last 3 years, I would say with good trades, bad trades, commission, execution, Three Stooges, everything, good and bad trades, the average, right, people are pumping out is somewhere in that 3 to 5% a week, right? So even though our target's 10%, a lot of times on trades, for many of the students that we have in our community, I'd say for the ones who are trading this every week, whether it be a butterfly, condor, or a calendar, the ones that are doing it every week, those are pretty normal numbers, about 3 to 5% a week. That's what the good and the bad for people who are doing it all the time. Did I say something March? So this trade is this trade would be March. All right. All right. Let me see if there's any other questions. If you have any questions, Wednesday, Feb 16th, our FOMC meeting in VIX might be high, good for an exit. Again, the goal on this trade that I'm putting on today, I'd like to be out by Monday or Tuesday at the latest. So I'm not going to expiration on this thing. Oh, I'm sorry. Did I say that right? March? Where are we at? Oh, you know what? I'm doing this. I think I made a mistake. Is that what you guys are saying? Did I say March? We are, oh yeah, March. I'm sorry. Yeah, this would be March that expires in 14 days, right? Was I saying February? I'm sorry if I said February. Now, usually, again, for 4 to 7 day trades, I'm not big into adjustments because it just is not enough time. But I will talk about adjustments a lot. I get a little more in adjustments if I'm like 8 days, 9 days, 10 days, 11 days, 12 days from expiration. You have a little bit of room. But I will go through on butterflies, calendars, iron condors, all the different adjustments and kind of the most effective ones, I think. that we've used on weeklies. Ethan says, Dan, does your students put this trade on every week? What do they do if the vol is low? Whether the vol's high or low, fat or skinny, generally putting this on every week. I mean, I think there's a few weeks during the year if things are just getting crazy, or if you can sit out 3-4 weeks. But if you're doing monthly trades where you put them on every 30 days, and you're only doing 12 monthly trades a year, you can't sit that many. But with weeklies, you know, you can. I would say people maybe sit out 3 or 4 weeks at the most. Let me see, any other questions? So what happens if bad news suddenly hits the tape and the market goes down by 30 points within minutes after executing the trade? You immediately exit or put on another at-the-money fly and hold 2 contracts and widen the profit potential. That's a mouthful. Let me see. And yeah, again, can these things happen? They do. Let me ask you, how often would you say it happens that bad news comes out immediately in the market and we drop 30 points in less than a minute? How often do you think that happens? How often do you think it happens that in the middle of the market we get bad news and in SPX or drops 30 points before you can blink? So I want to answer that question, but I just want to make sure we understand it. Are we talking events that happen a lot or events that happen once in a while? Very rare, right? I can't remember the last time that we had something come up that it dropped 30. Now, the good news for this trade is there's no naked options. So there's naked options. Now, the only way you can be, you know, again, you can't, just like if you're walking down the street, right? If you're walking down the street and a goat falls out of the sky on your head, you know, can it kill you? Yeah. Is it a rare event? It's probably a rare event. But, you know, if you were really concerned, if you were willing to give up some of the yield, you know, again, think of the insurance business. Can we buy insurance on these trades in the form of out-of-the-money calls or puts to cut your yield down on a weekly or monthly basis, but to assure that if we have a black swan, a blue swan, a goat falling out of the sky, bad news, ugly news, potential nuclear attacks, that any big move you'd be okay? Yeah, it's all in the world of insurance. You agree? So the nice thing about weeklies and the nice thing about trading options is whatever your risk profile is, whatever your concerns are, that's the beauty of it, right? That's why options are 1,000 times better investment than just buying stock, because you can hedge these things, right? Anyways, one last question. How big of an account do you suggest for that type of trade in SPX? Can't we use SPY? Again, let me ask you a question. If I came to you and said, let's say on this butterfly trade I'm talking about, how big should I trade? Anybody have what answer I should give? If I came and said to you, okay, I'm doing this butterfly trade, how big should I do? What do you think? What do you think the answer is? What do you think the answer is? Let me ask you a question. If I went to a race car driver, Rick Gordon, I don't know anything about race cars. Is his name Rick Gordon or Jeff, what's his name? Jeff Gordon, right? It's not how comfortable you are. If I went to Jeff Gordon and I said, Jeff, can I get in your race car and run it around the track? What do you think he might say to me? What in the world do you think he might say to me? Can you drive real well? Have you done it? So here's the key. When you're doing butterflies, what size should you trade? If you've never traded before, paper trade, right? Then you get into 1 contract, 2 contracts. Once you get consistent with 1 or 2 or 3, build your way up to 6. And I think a trade like this with the weeklies, can you get up to 10 or 15 contracts? I think you could, right? You can get higher. It depends. But what is it based on? How are you doing, right? Right? Got it? A lot of people will say, you hear these numbers like, only put 2% of your capital into options or put 2%. No, let me give you an example. Some of the experienced veterans in the Sheridan community, we have some that are trading some pretty good-sized numbers. Well, again, if you're really comfortable with options, right, and you're doing well and you're getting consistent, you're going to trade bigger. So it's just a matter of, it's not comfortable, it's how you look at how you're making money. So if I have a student in Sheridan Mentoring and they're starting out trading $5,000 or $6,000 of live trades, and they show consistency over 6 months, then they might go up to 15 or 20. And then if they show consistency for 6, 7 months, consistency making money for 6, 7 months, they might go up to 50. Does that make sense? Right? Wouldn't that be the same thing if Mark Reinhardt went to his wife and said, hey, honey, how much money of our family fortune should I trade with? Well, the wife would want to know, do you know what you're doing? Take $5,000, right? Let's see what you do. If you're consistent with 5, let's go up. So pretty logical common start, right? Am I teaching adjustments with futures? No. No, we're just going to, again, my goal here is to teach you over the next 3 weeks, repeatable trades, easy or no adjustments, very repeatable, something you can do. You don't need a degree from IIT or Harvard to do this, but I'm teaching you a craft. And that's why every class, all of the trades we're going to do live, walk through them, explain them with Word document, give you the step-by-step how I do it, how I adjust it, and we'll follow the trade from beginning to end. So for $297 to save you from going in and figuring this out yourself, I think you got to do it. I think it'd be a great help to you. So anyways, if you have any other questions or I missed, you can send me an email at dan@sheridanmentoring.com. Again, we're either going to start next Wednesday or the Wednesday after. I'm guessing next Wednesday. If you have any other questions on the class or specific questions about what we covered today, I would be happy to answer it. And if you miss a class, that's fine. All the classes are going to be taped, archived. And so let's say you miss a class on a Wednesday night and you don't get a chance to watch it till Thursday. You'll watch it, and then you could just fire in any questions you want on it, and they go directly to me. So anyway, folks, have a great day, and we will look forward to working with you on weekly starting next week. All right, thank you.